Welcome back to Best Friends in Franchising. I'm Morgan Knoller.
And I'm Catherine Allen.
Today, we're excited to welcome Kelly Krueger, Senior Consultant at Benetrends Financial. Kelly helps entrepreneurs and franchise buyers navigate the often confusing world of funding, from retirement rollover strategy like ROBS to SBA and traditional financing. With years of experience simplifying complex capital options and guiding clients towards smart, strategic funding decisions, she's here to break down what every future franchise owner needs to know before they invest. Welcome, Kelly.
Thank you so much for having me. How fun. I've been so excited to do this.
So Kelly, so excited to have you on today. And personally for me, this is not an area that I am still completely versed in. So I'm looking forward to learning from you on our podcast. So for those prospective franchise owners that are taking a stab at this and business ownership, what are the most popular funding options and how should they think about choosing between them?
Yeah, that's a great place to start. And, I would say that there's really four main ways that people are funding franchises outside of course, cash. But I don't see a lot of people these days just forking out a ton of cash to fund a business fully with cash, unless it's a very small investment. So most people are either using SBA funding, a traditional small business loan, ROBS funding, that's the rollover as business startup, where you can use pre-tax retirement funds, home equity like a HELOC, or brokerage loans. If they have a lot of money in the market in a non-retirement account, like stocks, bonds, and an after-tax account, you can borrow against those, like a portfolio loan or a margin loan. So those are the four kind of common ways that people are investing, and sometimes cash is included as a part of that, because it's oftentimes that people are using combination funding. They're not just doing necessarily one thing.
So when you say not just one thing, I'm just trying to think through this myself. Could it be they do a ROBS to pay the royalty fee, or that initial franchise fee, and then, their own cash for the initial investment startup cost, something like that?
Absolutely. Yeah. I'd say the most common combination is SBA plus ROBS. So
Okay.
right in line with what you said, and we kind of call that hybrid funding, but many people will use ROBS to cover the franchise fee and then
Okay.
use SBA for the working capital and the rest of the investment. Yep. Because a lot of people don't have a ton of cash sitting around in the bank, right? We wish, but not everybody has 50 or 100 or 150. I mean, when you get up into some of the higher investments and you have or like multiple territories, then those franchise fees can really start to stack up. And a lot of people don't have that cash. And if they do, they don't necessarily want to spend it.
And so when you're first talking to a future franchisee, what's the first step they should take to decide if they're financially ready? Or what questions are you asking them to determine, do they have enough capital? Can they get this SBA loan? What does that look like?
So that all comes out on the very first phone call, right? So when I chat with the client, I mean, the first thing I do is just take a few minutes to get to know them. I want to understand what they're trying to accomplish, because I can't do them justice if I don't know if they're looking for one small business or if they're trying to build an empire. And so we go through that get to know you phase and kind of get them comfortable and break the ice. And then I always ask them too if they have an idea of how they want to fund the business. Some people do, some people don't. And I'm sure we'll come back to that later on some of the common answers and misconceptions. Um, but then I just ask them for kind of a high level overview of what their assets look like. What does your liquidity look like? Even if you're not willing to use it, that's okay. It still counts. I want to know. Um, Brokerage funds, retirement funds, home equity. Those are the primary things that I look for as far as assets. And then I need to know what income looks like and what credit looks like. And when I have that snapshot, then I walk them through everything that's possible for them based on their assets, credit, and income. And I don't limit them just to what Benetrends has to offer either. If I see something that I think might be faster, cheaper, or easier, like a home equity line of credit or a brokerage loan, we don't do those. But we're still going to talk about it, because I want people to be educated, right? I want them to understand all of their funding options so they can make an informed decision about which option feels the best for them. Because let's face it, everybody's different where they're willing to take their risk, right? Some people say, you know what, if SBA may require a lien on my home, that's out right away. And some people say, hey, I'm not willing to touch my retirement funds. Or, there's people that just need to preserve their liquidity because they don't have income. They need to live off of that. So there's a lot of different factors that go into it. And so I'll explain all of those options to them and then help them kind of whittle that down to really probably what might be the best for their particular situation and make some recommendations on that.
Well, that just explained exactly why we send you so many people, because that's such an excellent first step for everyone to take before even considering what can they afford, what kind of a franchise is even within reach.
Well, it's so true because, I liken it, and I'm not the only one that uses this analogy, but I liken it to shopping for a home. You get pre-approved first, right? You don't start shopping for $1 million homes if really all you can afford is a $500,000 home. You don't want to waste your time. You don't want to waste anybody else's time, but you also don't want to disappoint yourself if you fall in love with something that really
Right.
just ends up being unattainable. So be smart about it from the beginning. And I truly believe that once these, potential franchise owners understand what their funding options are, and they know that you're going to be there to hold their hand throughout that process and guide them every step of the way, whether it's Benetrends helping them through the funding process or you helping them through validating the franchise possibilities and the franchise team helping them once they get started. When they understand that they've got a team of professionals in place that are going to guide them through every step of the way, it makes them much more likely and much more comfortable when they do continue validating. So I think it's just honestly a win-win for everybody.
Well, I know that I mean, first off, we're so lucky to have you, Kelly, as a partner to our team at the Franchise Insiders. And I know I spoke with you. I'm sure you speak to so many people, so you might not remember me, but we spoke when I was looking to buy soccer stars.
Of
And
course.
Jack, because I went through Jack and Jack referred me, to you. So, and again, that was such an area of education. I think you asked me what you just talked through, and I probably couldn't even answer half those things. So, I was definitely on that spectrum of very green when it comes to these things and really appreciated your professionalism and depth and knowledge and wisdom in this area. But going back to what first time franchise buyers misunderstand about funding, what does that really look like when it comes to risk and capital? Would you say what's
Excellent question, and thank you for the kind words. I appreciate that, and I do, of course, remember. And what you said too, before I even answer your question. Many of my clients are green. Many of them, it is the first time they've ever considered doing something like this, that they don't even know where to start, and it can be overwhelming, right?
very?
And that's
I was
where
so
again,
overwhelmed. I was so
well,
overwhelmed.
and here's another analogy I use all the time with people. I'm gearing off a little bit, but I liken the whole process that they're going through to putting together a puzzle. You dump out a puzzle that has that, 1,000 pieces. You dump that on the floor in front of you, and you have no idea how that picture is ever going to make sense. But you put every phone call that they have with someone like myself, with you, with a franchise, with a franchisee that already owns the business, they put a few more pieces of that puzzle together, and eventually the picture starts to become clear. So I always tell them, take it one day at a time. You're right where you're supposed to be. It doesn't all have to make sense right now. Um, but I think that to answer your question finally, I think a lot of people understand or misrepresent maybe the amount of capital that it takes to start the business. And this is not new to anybody, but the number one reason rather that people fail in business, new business owners, is because they go in undercapitalized. So we never ever want that for anybody. If it were me and I were trying to capitalize a franchise, I would go to the highest end of what the franchise is giving me. And if they tell you you're on the low end, I would probably put myself on the high end. Now, of course, when we're talking brick and mortar, that can be a $400,000 difference. So you don't need to necessarily overcapitalize that much, but I think that you want to overcapitalize at least 20%. Right? When you look at that franchise disclosure document, it tells you what the franchise fee is and what the total investment is. But that's maybe, the total investment is maybe what for a 3-month period or so. you want to make sure that you have at least at a minimum 6 months of like personal living expenses set aside and in business expenses as well. And I would say more. I'd say six minimum, 6 to 12. And if you don't have income coming into the household during that ramp up, because we see that all the time, right? People have been downsized from corporate America. So then you want to prepare more. So I think, there's 99 reasons that you can fail in business. Access to too much working capital sure isn't one of them. So overcapitalize yourself, and you're going to certainly minimize your risk when you do that. And then the other thing I would say is that, sometimes people shouldn't start with multiple territories or multiple units. I think you have to know yourself and your limitations and where your skill sets lie. And I do feel like I see some clients that overestimate their own abilities, and they overestimate what the franchise might be able to provide to them. Yeah,
Mhm.
it's a proven system. And if you follow the system and you do all of the right things, you're going to be successful. But that being said, they can't do everything for you, right? They're not there going to be holding your hand every single step of the way. So, if you're somebody, for instance, that is not good in sales and cold calling, well, then you need to pivot to something that's maybe more B2B where you don't have to do those types of things. And if you're a little bit greener and you've never had a business before, or maybe you don't have a lot of time to dedicate to it because you do still have another job, then pick something appropriate. Don't go from zero to I want to own 20 franchises in a day. Start smaller if that's the best place for you, and then build on it after you kind of get your feet wet and figure out how it all works.
Well, I'm so glad you brought that up because I've been doing this for 16 years. Jack and I worked together at a senior care company prior to joining Soccer Stars. So you know, it like because I don't think people think through when you're buying I mean, I think if you it's all about capital. If you have the capital and you can make it work and you have that runway to support yourself. I think that helps a lot. But like, it's not just purchasing the territories, it's the money that goes into developing the territories and the time. Because typically, if you're buying multiple territories, one is in your backyard, which is great. That's like Soccer Stars for me. I started with one territory. I didn't buy a second territory until last September. And that was 2 years in, essentially. It's because I didn't have the capital. I had to start with one, build it up as quickly as I could to get the cash flow, and then I could afford to buy another one. And by that time, I knew what I was doing. I was confident.
Exactly.
Had my processes down so I could then expand much more
Yeah.
quickly. And that was my strategy. And I come from franchising, so I had kind of seen I knew a lot coming into it. And then just that was my strategy there. But I think with the multiple territories, it's like the money you put into marketing and sales, you need double the capital, right? Because you have 2 units. So I just think people don't always think that part through. And yeah.
Well, it's absolutely true. And again, you don't know what you don't know if you've not been through it, right? And a real world scenario, I just had this happen with a client. She bought the rights to open 3 brick and mortar physical locations. And the first one was taking longer. The first build out was taking longer than she anticipated. That happens all the time, either because you can't find the right location, or you're struggling to negotiate a lease, or whatever it may be. It can take longer than what you expect it to. So that starts burning through your capital, right?
Right.
And then also sometimes when things cost more than you project them to be, costs go up. And that can happen on a dime when we least expect it. So yeah, sometimes there's a lot of unexpected cost that create, or delays that can create costs. So this client said it's taken longer to open the first one. So, hey, I want to get started on the second one. And she was doing ROBS for all of these. She was going to set up a second ROBS, separate corporation. And so we got started on the second one. And she came back to me within a week and said, whoa, I need to put the brakes on that because my projections just came back from the contractors and it's a lot more than what I expected it to be. So Again, it all goes back to planning worst case scenario. Always go worst case scenario because it's great if it's less than what you expect, but you're never going to go wrong if you project high in you're prepared.
I think that kind of rolls us right into the next question too, because similarly, I have a client right now. He left corporate America. He's unemployed. He wants to buy a franchise, so he has about 150,000 in cash. So he's kind of ready to go, but he wants a brick and mortar. So it's probably going to be that combination type of thing that you
Mhm.
talked about, where the structure is very different. If you have 150 cash versus if it's a $750,000 investment or more, depending. He just wants one territory, so probably not more. But with each level, I mean, what do you tell buyers to consider? Because at 150, he's good to go. But if it is at that 750, then he really is not ready at all.
Yeah, it always boils down to liquidity, truthfully, like cash flow and how much liquidity do you have? It's the old adage cash is king. It's so true. And so, if you are limited, then you do need to start small because the higher the investment, the more out of pocket that's going to be required from you. Um, and it makes a big difference if you have income coming into the household or not. So I think that there's, how I guide clients, like I was saying in the beginning, all of those factors come into play. And you want to make sure that you put yourself in the very best position from day one to be successful, because then you can build on it. But if you go too hard too fast, I've seen that happen too. We all have, and that makes everybody sick to their stomach. None of us want to be part of that, right? Because we all know that people work a lifetime to save money, to build retirement funds, build equity in their homes, and we all want to be very responsible when we're guiding and helping people. So I think that, yeah, we have to take all of those factors into play.
Yeah, and you helped me understand that as well, Kelly, when I was looking at housing cars, because I initially only wanted brick and mortar. I wanted the shiny new object. I had my heart set on something like a coffee shop or avocado toast. I don't know. I had these big dreams, but in talking to you and really understanding what was comfortable for our young family with young kids, I was very uncomfortable with doing an SBA loan or something that would just financially stress our whole family. So then I was looking only at really 150,000 or less for the investment, and it was a lot easier to pull the trigger and get going and ramp up fast, just knowing that it wasn't going to put our house on the line or something that I was uncomfortable with. So I think it was very wise of you to walk me through that, and I'm very glad you did.
Well, hey, I'm really glad to hear that. And again, I think it goes back to misconceptions, right? You just don't know what you don't know.
Right.
And
Yeah.
brick and mortar is certainly going to be riskier, for people that want to minimize risk, like, age comes into it, right? Like when I'm trying to guide clients on maybe what their best funding strategy is, age is a big part of that. Because you're going to take maybe different risks with different assets if you're 35 versus 55.
Yeah.
So yeah, if you're looking to minimize risk and you haven't done it before and you're kind of green, then a home-based business probably is a good way to go. And people, it just doesn't seem sexy, right? But the the banks love them. The banks love home-based businesses, and especially in the service category, because those are a little bit more recession-proof, right? People, if your plumbing goes out or your heating goes out in Michigan, like where I'm at right now, we're we're getting it fixed. Even if you can't really afford to, you can't afford not to. So those types of businesses really stand the test of time, and they're gonna minimize risk for somebody that either is risk averse or just needs to be very, very careful about their next step.
All right. Well, let's switch gears and dive into different funding options, starting with ROBS. So, Kelly, what does ROBS stand for? And can you walk us through the structure in
Yeah,
simple terms?
sure. Now this is my favorite part of the conversation. Rob's I get very excited about is truthfully what I know the best because it's what I I do kind of most often. ROBS, that it's a terrible acronym, right? Somebody had a sense of
Always
humor.
trying to remember what it stands for. I get the
Well,
rollover, and then I always forget the S.
it's a rollover as business startup. And we've coined it the Rainmaker Plan of Benetrends, which sounds a lot nicer than ROBS. But the industry term is ROBS. And um, to break it down to the easiest way to understand it, the gist of it is that ROBS gives you the ability to take pre-tax retirement funds like 401ks and IRAs, and instead of investing them in the market and buying stock in someone else's company like Amazon or Coca-Cola, you can invest that money in your own company and use it as operating capital without taking a distribution and paying taxes and penalties on the money. It's also not a loan. The money does not have to be paid back to the retirement plan. Of course, everybody wants to pay it back. You want to rebuild your retirement plan, and they do, and they will, but it's not required. So they can do that on their own time. And ROBS is done thousands of times a year in franchising. Outside of franchising, nobody knows it exists, but it is not new. We've been doing ROBS at Benetrends since 1983. The founder of Benetrends actually pioneered it. He's an ERISA attorney, a tax specialist. It was his idea. He figured it out. He worked with the IRS to develop it. So literally over 4 decades, ROBS has been around. It's extremely, extremely well established.
So I have a quick question. So I think I did ROBS and I borrowed against my husband's 401k. And so I know he pays himself back in every paycheck. Does that make sense? Is that what we did there? Or is that
No, it sounds like, and I apologize, I don't remember what we did, but it sounds like what you're talking about is he just took a loan from his 401k.
oh, so that's a different option.
Well, did he take a loan from his employer plan, or did we set up a ROBS for you?
So I think I just took 50,000 from his 401k.
Okay,
And
that's
then he's
not
so
ROBS.
that's different.
Yeah,
See,
that's
this is good. This is good for our listeners. See,
there.
I'm eating confused. So that's different. So that's just so you can borrow up to 50K, right? Against your 401k. Is that a different
Yes, that's different.
right?
That's totally different. And you don't need us for that. So if you have a 401k or an active retirement plan with your employer, you typically can borrow up to 50% of the balance, not to exceed 50,000. So even if you have 500,000 in it, you can't borrow more than 50. And then, yes, you pay it back over a 5-year period with interest. Well, you can go up to 5 years. You don't have to take that long, but you pay it back to the retirement plan with the interest. And so typically they take a certain amount out of every single paycheck to
Yes.
pay that loan back. So yeah,
Okay.
that's an option for people too that need more capital to like maybe qualify for SBA or just bridge a gap in liquidity somewhere. Many people can borrow against a retirement plan like that if ROBS is not an option.
So
And
with
so
ROBS, is there interest that you're paying?
No, because it's not a loan. Do you want me to take a minute and just kind of walk through what the setup looks
yeah,
like?
because
Okay.
I have follow-up questions too.
Yep.
Yep.
And I'm going to get really wordy here, but I'm going to give you a couple different examples and just bear with me because I think at the end of it, it makes sense. So I use my own history in corporate America as an example of the structure of ROBS because corporate America has been doing this forever. And what I mean by that is I used to work for Sanofi Aventis, the pharmaceutical company.
Mhm.
I contributed to their 401k plan as a W-2 employee. And one of the investment options within my 401k was employer stock, Sanofi stock. So I bought some. And when I did that, then my 401k obviously was holding that stock within it as an asset, right? And the value fluctuated based on the performance of the company. The money I paid to purchase that stock transferred from my 401k directly to Sanofi's corporate bank account. They sold their stock, they got paid for it, and then they turned right around and used that as operating capital to pay our salaries and to buy inventory. Same with any big corporation. You buy Amazon stock, Amazon takes your money and operates Amazon. So ROBS is really the same structure as that. You're just both sides of it. You're Amazon or Sanofi, the corporation that is selling its stock for operating capital, and you're the employee that's using your retirement funds to invest in the business and purchase the stock. And then that becomes the operating capital. So does that make any sense at all?
It does. So if I just to make sure I fully understand this, so I have a 401k from my old company that I had left. So that's investing in stocks. So I take 50, call it 1,000 out, and then that's just what it is. And then that you don't get taxed on that. That just goes into the business.
Yep. And here's those extra steps of how you get from where you just said to where the money's in the business. So the first thing that we do is we set up a C corporation as the operating entity to run the business. And then you wear two hats. You're the owner of that corporation, and that corporation hires you as a W-2 employee. And then at Benetrends, we custom design a retirement plan for your corporation. And that retirement plan will be the retirement plan that makes the investment into your business and purchases your stock. And we typically use Fidelity as the custodian for that. So when I say retirement plan, it's going to be a qualified, pre-tax retirement plan, either a 401k, which we're all used to, or a profit sharing plan, but it'll be a qualified plan. We open that at Fidelity, and then your 50,000 in your example rolls from whatever retirement plan it's in now to the new retirement plan that we just set up for your corporation at Fidelity. So it's a direct rollover from one retirement plan to another retirement plan. Most people have done a rollover of some sort, right? So it just goes between qualified retirement plans. So there's no distribution there. And once that 50,000 lands in the new Fidelity retirement plan, instead of investing that money back in the market and buying Amazon stock or Coca-Cola stock, it's invested in your corporation, and it's used to purchase Catherine Enterprises stock. So the money leaves Fidelity and it gets wired out to your corporate bank account, which you open anywhere you want. And once the money's in the bank, now you have 50,000 in operating capital from the sale of the stock. Just like my Santa Fe example, your corporation sold its stock, it got paid for it, and now you have 50,000 in operating capital, just liquid cash sitting in the bank account, and that money can be used for absolutely any business expenses. You can pay the franchise fee. You can buy equipment, lease space. You can use it as the cash injection for an SBA loan. You can even use it to pay yourself a salary like day one for people that are in between jobs and need a salary. They can start paying themselves right away. So that money can be used for absolutely any business expenses. And some people will fund their entire business with ROBS and go in debt free. They're obviously profitable faster if they do that, right? Because they're not saddled with monthly payments to the bank. Cost of capital is less because they're not paying interest rates, which are still kind of high, even though they're coming down. We'll come back to that. But you also can use ROBS in combination with an SBA loan, like the cash injection or cash reserve dated for SBA. You can use ROBS in combination with anything, cash out of your pocket, a HELOC, home equity line of credit, brokerage loan, anything. So it's extremely flexible in that regard. And it's also not a loan. Money does not have to be paid back to the retirement plan. But in 15 years doing this, I've never met one person that didn't want to rebuild that retirement plan, and they will. So I'll come back to that if you want me to. But I know I just said an awful lot of words there. So I'm going to take a breath and tell me if that makes some sense. And please jump in with questions or if you need me to clarify something.
Yeah, I think I was just going to ask you who is a strong fit to set up a ROBS or to use the ROBS, and I feel like it's almost like who shouldn't do it. I mean, I kind of feel like maybe I should have done that. I pulled out cash and I sold my stock, was taxed on the gains in order to buy my franchise. And I'm looking back thinking, I wonder if that was the right decision, because if ROBS would have made it, I mean, I wouldn't have had the debt, but I would have paid a lot of taxes that year for
Yeah,
sure.
well, it depends. So I love that question. Thank you. ROBS is definitely not recommended for anybody that's not prepared or doesn't have access to a minimum of 50,000 in retirement funds. It's not that we can't set up a ROBS for less than 50,000. It's just cost prohibitive to the client. So it works for us, but it really doesn't work very well for the client. So we don't want to do that. So 50,000 or more. And you can combine from multiple accounts too, multiple types of accounts, multiple people. So for example, if you have one spouse that has an IRA and another spouse that has an old 401k, we can combine both of those. But 50,000 is the threshold. And then from there, there's a couple other things I would say. It really depends on the individual, the financials of the individual. So if somebody has a lot of funding options, let's say everything's on the table for them, right? HELOC, SBA, ROBS, brokerage loans, cash, they can do whatever they want. And if they only need maybe 75,000 or 100,000, then I might not recommend ROBS in that situation because there may be simpler structures for them. Maybe a loan in that situation, and this might be exactly why you did it, Morgan. I don't remember, but sometimes it makes more sense to just use something else and then set up an LLC and a different structure, a different business entity instead of a C corporation, because that does add a layer of complexity to things. So I think a big component of it is how much money do you need? How much operating capital do you need? What's that total investment look like? And then the other thing that factors in also is age. You know, if somebody is real close to retirement or already into retirement, I don't want to see them necessarily pull out all of their retirement funds. If they've got some, maybe using a chunk of them, absolutely. I mean, I'd say most of my clients are actually 50 and over, and they're doing ROBS, but maybe not for the entire investment. So I think the whole financial picture comes into play. And then when we're talking about age, I can reverse it also and say, hey, somebody that's 30, 35 years old, ROBS isn't always the best option for them either if they have other options, because they're very far from retirement. And, you know, they they maybe don't want that money going back into the retirement plan. So there's and if that's the case, it doesn't mean that we can't do it. We do, but there's just a lot of strategy that goes into it, and I won't bore you with those details. But I guess the bottom line is that every client is we have to individualize how we're going to structure everything based on the client's specific circumstances, and sometimes that there's a lot that goes into that to making sure that we're doing the very best thing for them when we capitalize that business.
I have to say, even at training, I remember, Catherine, our little group that we had when we went to New York to start our franchise, everybody had an LLC for sure, but some people were already setting up corporations. Some had used SBA loans, some had used retirement plans, some were just straight cash. And so it was really interesting. Like no one had done it exactly the same at that
Yeah,
table. There were a lot of
right?
us. Yeah.
Yep.
Yeah.
That's exactly right. But for small investments under 100, yeah, I mean, I wouldn't probably set up a C corporation if I didn't need to. So that's not to say that ROBS is not a terrific option for somebody for 100 or less. But there's just if sometimes it's better not to if you don't have to.
Yeah.
Keep it simple, right? Keep it simple, stupid. Is that what they say?
Yes. Yes, it all goes back to KISS. Let's transition over to SBA loans and traditional lending. How does the SBA financing work for franchise buyers, and what do lenders typically look for in terms of credit, liquidity, and back?
So cash is certainly king. Again, old phrase, but still holds true today. It's all about liquidity, liquidity, liquidity. So a lot of liquidity can overcome some other things. And it won't overcome bad credit though. So we typically want to see everybody at least 685 or better when it comes to credit. And if the spouse is going to be on the loan, they've got to be in that same arena. If the spouse, and we run into this all the time, if the spouse maybe doesn't have great credit, okay, well, we can try to keep them off the loan if the other spouse can qualify without them. But sometimes they don't, right? Sometimes you have somebody with great credit that's not working. The spouse has bad credit and they are working. So we can't do it without both of them. So credit is a big one. Liquidity is a big one because you're typically going to need 20 to 30% liquidity of the total investment. You're going to have to inject 10 to 20% of the total investment out of pocket. And then that's not the end of the story. Whatever the loan amount is after your skin in the game, whatever the bank lends you the loan amount, they want 10% of the loan amount left over is post-closing liquidity. Just money left in the bank or in your corporate retirement plan, or I'm sorry, corporate bank account rather. They just want to see that you have a rainy day fund. That's it. They don't want to take your last dollar. So liquidity certainly comes into play, and collateral comes into play too. So if your loan is 350,000 or greater, the SBA is mandating to the bank that they capture collateral if it's available. So if you have equity in your home, there's going to be a lien on it, 350 and over. That's just not optional. And we're going to have a hard time getting you over 350 for a loan if you don't have collateral. A home isn't the only thing they can use as collateral. It's the preferred asset. If somebody has, a lot of liquidity or money can be put in a CD sometimes or something, or maybe you just inject more cash and have more skin in the game. So there's a lot of different ways you can paint that room. Um, but equity in property is their favorite form of collateral. Under $350,000 loan, collateral is optional. The bank doesn't have to have it, but they can require it if they want to. So it really just depends on the bank, and the newer the franchise, the more likely the bank is to require collateral, or, maybe the less strong, that's not the right way to say it, but the stronger the borrower, the less likely they are to need collateral also.
Right. And then I know there are some delays that happen with SBA loans. So I want to talk a little bit about what that timeline looks like from like applying to get your SBA loan to actually having the physical loan. I know I've sent you clients that unfortunately their credit scores weren't great. So they
Yeah.
are on hold and they're trying really hard to get their credit back up. So that was clearly an obvious delay. But what does that timeline look like?
So, if it's home based, if it's like a home based business, I tell people plan on 60 to 90 days. That's a pretty good estimate. And if it's brick and mortar, it's going to take longer, right? Because it's a little bit more involved and you've got renovations and things. So average for brick and mortar, I would say 90 to 120 days.
No credit score for sure.
Credit score for sure. And even once you're into the process, if it's brick and mortar, a big delay is if you can't find a location. You can't find a suitable location, so that can really drag things out. Even when you do find a location, it can take time to negotiate a lease. So all of those things can add time. Or if the franchise is not approved yet on the SBA directory, that's another one. I'm running into that right now because the SBA went away, right? We had the directories, then they did away with it, and then now it's come back, and not everybody's approved on it, or new franchises have to take the time to get approved. So if they're not approved on the SBA directory, SBA isn't an option until they are.
Especially these new franchises. I can't imagine that's even on their radar right away. They're just trying to ramp up. These franchisors are probably like, oh my gosh, we didn't know we had to do this.
Yes, that's exactly right. So oftentimes it's us telling them, hey, we can't move forward until you do it, and here's how you do it. Here's what you need to do.
Let's move on to veterans. I know that's in Morgan's wheelhouse, and given her husband is in the military. Are there any specific financing advantages or programs available for veterans, and what does that look like?
So for veterans and military, there's no specific special loan for them. They still have to meet all the same qualifying criteria, the credit and the cash injection and cash reserves. However, we work with a lot of lenders that will either give them special, discounted interest rates, or, just eliminate fees and things. So there's definitely advantages there, no doubt about it.
I actually found, at least with the VA loan, we hadn't used our VA loan ever. We finally did to get our house for the first time. We've always done conventional loans. And when we did, the process was actually more grueling than I thought it was going to be. There was like more checks and balances in place for veterans. Is that similar to getting like a business loan or no?
Well, you just hit right on the money, because you helped me remember what I was trying to say with what can add delays to the SBA process. Ding, dang, you win, Morgan. So one of the things that delay is the client themselves, because we can, we can only move as fast during the initial like packaging phase, because we have to package before we ever get to the lender. And packaging means we're helping the client gather all of the documentation that the bank needs to underwrite and approve that loan, their financial information, completing the SBA documentation, the personal financial statements and things, the business plan, building out the cash flow projections. And so we can't go to the lenders and start shopping rates and terms till we have a completed package. And that's hard sometimes for clients to do. Some clients require a lot more help and guidance than others. And some people, just because they don't know how to do it, they've never done it, or because they're busy, they're all working 80 hours a week and they don't have the bandwidth. So that is, and I'm not making a plug for Benetrends here, but that's where there's a real advantage to working with a company like Benetrends, if it's not Benetrends, where we have the expertise in place and we offer those services. For example, we offer multiple different loan options for people, or loan packages, that if somebody wants a basic package and they just want some guidance from us along the way and templates, they can pay for that. If they want us to do the whole banana and write their business plan, do their cash flow projections, we can. They can hire us to do that. And that's our elite package. And when we're doing that work, that speeds up the process, because we don't get questions from the bank when we submit that loan package. They're not coming back asking for changes to the business plan or the cash flow projections, because we did it right the first time. So there's things that can speed it up along the way.
Excellent. I'm going to skip right down to the current market trends, if that's okay. So, Catherine, I know you had a question about the interest rates. Let's start there.
Yeah. So, with interest rates where they are today, how is that impacting franchise funding?
So the trend I've seen over the last 4 years, since rates have skyrocketed, many more people are fully funding with ROBS if they feel like they comfortably can, or they're funding more with ROBS and retirement funds than they would have in the past, to minimize that loan amount and keep that loan payment down, and also minimize the amount of money that they're kind of spending on interest. So I've seen a huge shift in the market over the last 4 years.
So are lenders then, are they lightening or loosening requirements due to the high interest rates? Or the high interest rates, I guess, would then kind of disqualify people right away or turn them away from doing it?
Yeah, lenders, when the rates are high, they love to loan, because that works to their advantage. That's good for them. But truthfully, I haven't seen either. I haven't seen it get harder or easier. The one big change here recently is SBA just keeps flip-flopping back and forth on what they're going to allow non-US citizens to do and what role they can play in SBA. So it used to be, up until I think June of 2025, if you had a green card or permanent legal residency, you could own, I want to say maybe up to 49%. Don't quote me, because I forgot. They've changed so many times in the last 6 months, I can't keep up. But I want to say you could, at that point, own 49% of the business. Then they changed it, and you could only own 5% of the business. And now they've flip-flopped again, and if you don't have US citizenship, you can't own any of the business. You can't be on that SBA loan at all. You can't have any ownership in the business if you have a green card or a permanent legal residency. You've got to be US citizen. So that is honestly kind of a gross change. In my opinion, I'm not happy with that at all. I'm hoping that in 10 minutes they change it again, because they just keep flip-flopping. But that's a big change, and that's really negatively impacting a lot of people right now that we're having to go back to, that had green cards that we thought we were going to be able to fund with SBA, and now we have to look for alternatives. And to save you asking the question, loan alternatives, it's unsecured. We have to flip to unsecured loans, because if you have a green card or permanent legal residency, we can go unsecured instead of SBA, or if they can do something else, ROBS or something.
That's very disheartening to hear.
It's beyond. Yeah.
Yeah, that's probably a light way for me to say that.
Yeah.
Let's wrap up with one more question. That's what industries are getting funded the fastest right now?
Home-based, I'd say home-based and service-based businesses. Yeah, service-based, home-based businesses. Those we can typically get through pretty pretty quickly without too many hiccups in 60 to 90 days.
Right. And we'll end with the rapid fire really quick. ROB or SBA? What's your preference? Great.
ROBS.
Low investment, high hustle, or high investment, semi-absentee?
Oh, depends on the client's situation and the client. I
Sure.
can't answer.
Best, in your opinion, best franchise industry right now?
Home health care.
Biggest funding myth?
That if you do a ROBS, that you're going to get hit with taxes and penalties.
Awesome. Great job, Kelly. Thank you
Kelly.
so much for coming on today. This was so educational, as I knew it would be for myself, our
And me.
listeners. For everyone listening, if you have more questions and want to be connected to Kelly, please go to thefranchiseinsiders.com, by Morgan or myself. On the drop down, reach out to us. We can get you connected with Kelly regarding everything she talked about today. Obviously, such a wealth of knowledge, and just really appreciate you as a partner, Kelly. So thanks for coming on.
Well, ditto. Right back at you. Thanks for having me. It was a blast, and we couldn't do it without you, without great referral partners like yourself. So anything that we can do to help you or your clients, we're all in. Let me know.
Thanks, Kelly.
Thank
Kelly.
you. You guys have a great day.
You too.